everybody for coming, and we're going to start right now, and I want everybody to be seated. You're all welcome to DingDing TV. We're a Silicon Valley Innovation Channel, content and connection for entrepreneurs and investors. So here with me is gentleman Doug Renert, and he's the co-founder of Tandem Capital, right?
That's
so
right.
Doug, you're going to tell us something about this capital and also about yourself?
Sure, Diana. So I founded Tandem Capital about 10 years ago. We're a seed fund and now a studio focused on investing and growing technology startups. We focus on startups that have some sort of innovation and how they go to market. Some of them are hardware companies, some are software companies. We do both B2B as well as consumer businesses. We're on our third fund right now. It's a $100 million fund. We've evolved over the years. We started kind of our life as a pre-seed fund. We invested very early. We had almost an accelerator-like element to our program. But over the last couple of years, we've migrated further downstream. Now we just consider ourselves a full-fledged seed fund. We invest a little later in the life cycle of startups and actually invest oftentimes after a startup has already taken some angel funding or some pre-seed funding or gone through an accelerator or an incubator. So yeah, there's been a little bit of an evolution in our model over the years.
Mm-hmm. So I want to ask, how many of you are the startups yourself, and how many of you are entrepreneurs? Can you raise up your hand? Wow.
Okay, most
of them. So you probably experienced many of the difficulties when you raise fund, and so Doug is going to tell you share his experience. So today we're going to share with the pitfalls of the early stage funding raising. So actually, each company has their purpose. So when you started a company, and what brought you to this industry, and why you're doing what you're doing?
Yeah, I had been an entrepreneur myself, had started and sold a company, and I was going to go do another business, and then kind of in the end decided instead of building one business, I would actually create a vehicle that could help many businesses, and that was Tandem in the end. In a lot of ways it was a startup itself at the beginning, and our kind of mission was to help founders kind of when and how they needed it most, both with funding as well as with kind of hands-on input. So we've always been, I would say, an active, kind of involved investor. For better or for worse, we certainly will write checks and provide funds to our startups, but we get pretty actively involved. Less involved now than in our early days. In the early days, we were investing in companies that usually had just 2 or 3 people, very early prototype of a product, and we'd work with them to find product market fit, basically. Now that we are a little bit further downstream, we'd like to see a little bit of product market fit already when we invest. The teams might be a little larger now than they used to be, but we still are focused on helping them however we can. That's actually why we created a studio. We took a lot of the people that were helping the pre-seed companies that were part of Tandem, and we just basically spun them off into a studio, which now can help both our portfolio companies as well as any startup or even larger company when it comes to user acquisition and growth and things like that. So we still have the same mission of helping founders with funding and involvement. We've just kind of adjusted to the market with how we deliver those things.
Yes, but your company is still a startup company, right? For the fund company is still a startup, but being a startup for the founding company and startup for the startups, the founder for the startups, and what's the difference? You were the founder for other startups.
The difference between when I was a founder,
right now you are the founder for this.
Yeah. Well, I mean, in some ways we're no longer a startup because we've been around for 10 years, but I think it was very similar when we started Tandem because you had to have You had to have a mission. You had to find product market fit, just like an operating startup would. We had to figure out who needs what we provide, and are there enough of those folks out there, and can we make money by investing and helping those businesses, just like an operational startup's founders have to figure that out. What is their market? How do they get in front of that
So that's a similar, right? What's the difference?
I mean, I think probably the biggest difference is focus. I think with an operational startup, you have to be extremely focused on that one business and kind of whatever the problem is ahead of that business. And you know, those problems may change as the company grows, but you have to be singularly focused. As a fund manager, as a venture capitalist, you cannot be that focused because you have many companies relying on you, and you have to be kind of able to switch gears as you move from conversation to conversation with those startups. I enjoy that, but I have to say at the same time, I miss being able to be so focused. Sometimes I wish I could be. I think being focused on solving a single problem is actually fun and rewarding, and sometimes I feel like I'm spread too thin as an investor, and that's just, you know, one of the, it's a plus and a minus. It's something you have to be comfortable with as an investor.
Yeah, as an investor, you cannot you cannot focus on one thing. You focus on different things. But what is the most important thing?
I mean, I think it comes back to what our mission was, which is providing value to the founders who we invest in. Because if you're a founder and you're raising money, what you really should do is go talk to other founders who have raised money from the investors that you're thinking about. And they can provide the best feedback on, hey, are these people helpful? You know, especially when times are tough, do they have your back? Will they do what's necessary to support you? And I find if we at Tandem are able to do that over and over again, that word spreads, and you know, it kind of begets more success. If you can't add value to the founders you're backing, then I think it's very hard to build a sustainable business, because you know, why should that next company who's coming through take your money or want to work with you? There's, these days in particular, plenty of available capital, especially the earlier you get in kind of the capital markets. Now with angel lists and all these accelerators, so many places early startups can take money. If you're not adding value, you're in a very difficult position as an investor.
Yeah, that's very good. So you give a good suggestion for startups to identify the good investors. But as an investor, how do you identify the value from a startup?
Yeah, well, that's the trick. I mean, it's in our old life where we were kind of a pre-seed investor and almost an accelerator. That was very, very difficult because you just didn't have much information to go on. Sometimes the teams had only been together for a matter of a few months. There you're kind of using your gut and your instinct and looking at the backgrounds of the team to figure out what they know and how you think they will operate in a new business. And of course, you want to see a large market opportunity and have a thesis on why this particular company can crack that market. There's always incumbents, there's always competition, so there has to be some reason why a new player can emerge and take over a market. Now that we're a little later in the ecosystem, we actually look for early metrics. You know, we'd like the product to already be out in the market. It doesn't necessarily mean that it's growing incredibly fast yet, but we want to see customers using it. We want to see customers who love the product or the service. And then, of course, we want to see a great team, but being a little later in the cycle, we have more to evaluate on that team. Did they get this product into the market? Is it a great product that the customers love? So I think in that sense, our jobs become a little bit easier as a slightly later stage investor, but there's different challenges now. Now we have to find these companies at the exact right time before they're growing too fast, at which point they kind of leap over us. they'll go get a Series A investor, and we're kind of out of the game. And of course, we want to, if we come in too early, then we're taking too much risk. So for us now, the trick is finding those companies just when that evidence is emerging, those early stage metrics are becoming available. You can see that maybe for the first time, customers are loving the product. It's maybe just starting to grow ever so slightly. The economics are starting to become clear and hopefully are positive. So that's kind of the formula now that we're just a traditional seed investor.
Yeah, I believe you've been talking to thousands of startups, right, for all these years, yeah. So
Absolutely,
what are the common mistakes they will make?
Yeah, well, I mean, many mistakes that I think we've all made over the years. But one thing I would say, kind of going back to the topic you mentioned of pitfalls of early stage funding or kind of early stage programs even, I see a lot of focus, in these accelerators and these programs on just getting growth, right away. And then, in these cases where there's a demo day, okay, by the time you're in the demo day in 8 weeks or 10 weeks or 12 weeks, you want to show this like hockey stick growth. I think that can be a mistake because if the product is not working like it should, the customers don't love it, that growth can be
a fake one, right?
Yeah, it can basically be illusory, and you'll lose those customers or those users before you know it, because the product didn't really have enough foundation to begin with. So we're much more focused, for instance, on again, the customer engagement, the customer retention. Are they sticking around? What's the net promoter score? How much do these customers love it? And we feel like if you're a B2B business, you may have only 1 or 2 customers, but if you're checking all the boxes on those customers, we can get pretty comfortable that you'll find many more. If you're a consumer product or service, you may only have several hundred or several thousand customers. But again, if they love it and they're sticking around, we can get comfortable usually that you can get into the hundreds of thousands and millions and tens of millions or whatever it takes. If somebody just comes in and says, oh, look how fast we're growing, but there's kind of nothing behind that, that usually is a little bit of a red flag for us. Now, of course, we do also love to see growth, but sometimes I just think it's pursued too early, too early in the equation.
Yeah, many of the startups, actually, they have a choice to go to an incubator or accelerator. And what do you say about this?
Yeah, I mean, it really depends on what the needs are of the startup, and just like I was mentioning for investors, what can that particular accelerator or incubator provide in terms of value? I mean, one thing that I think is very important is it's really just an early step in the journey, right? It's not kind of, even if it's Y Combinator, one of these top accelerators, it's not it's not an end. It's just kind of an early means to hopefully a great outcome eventually. But I saw some statistic that even with Y Combinator, which I think is probably the top accelerator in the world, something like half of those companies are dead within some number of months. So, hey, that's still great numbers
so why they
for
dead?
Y Combinator.
What's the reason?
Well, I think it's just very, very difficult to build a great business. I mean, to find product market fit, to outwit the competition, to come up with something that's differentiated and sustainable. It's very, very challenging. So, Y Combinator is just one organization, one program. They're now doing, 100 and something companies a year. Nobody's going to have a perfect track record. I think they're there just to give great founders a chance to succeed, but the mathematics just say that most of those founders are not going to succeed at the end of the day, and that's something we all kind of realize going in.
Mm-hmm. So what are the challenges you are facing in the model in your industry? You see the change of the trend?
Yeah, I mean, there's always challenges, right? I think one thing is there are only going to be so many huge businesses, billion-dollar plus businesses created every year. So as an investor, you have to try to find your fair share of those businesses. I think another way to deal with that is to, even if you don't have a company get to X billion dollars as an investor, if it can be, if you can kind of minimize your losses and even have like minor wins along the way, that can work also. So sometimes with Tandem, we'll have a great outcome that didn't quite get to the unicorn level, but we'll have companies that in 2 years sold their business for $100 or $200 million. It can still be a very good return on capital. What it also does, I think, for these founders is it gives them even more kind of flexibility and room to try something big next time. If some of these founders, if they make a few $1 million or tens of millions of dollars, they typically don't just say, okay, I'm done. They get the bug, they want to do more, but now they can fund it a little bit themselves before they go outside. They can take more chances. They can aim higher. They can take more risk. So that's a good thing as well. And for us, when we talk about helping founders, we view some of those outcomes where we put the founders in that position as a success. Maybe not quite as much as the $1 billion plus outcomes, but still a success.
Can you give us 2 or 3 examples that in the past you invested some of the company and the founders you're really proud of?
Sure. Yeah. One company I can talk about just because it's very easy, I can show it, is this company Tile. I have a Tile on my keys here. Probably many of you know about Tile. Some of you may not, but it's essentially...
How many of you knows? Wow. See?
Yeah, so it's a very simple concept. It's a device and a network of people who own these little devices to help us find our things and make sure we don't lose valuable items like our keys, wallets, purses, etc. When this team came into Tandem, it was in our kind of older, earlier model, but they were two guys with kind of a little prototype development board and a PowerPoint on around what they wanted to do. We helped them kind of figure out how to promote that, how to market it. They got some early traction, and now it's probably about 3.5 years later. They're doing 9 figures annually in revenue. They've grown from 2 people to, I don't know exactly the number, but probably over 100. They've been hiring. I mean, these were young guys with very smart, but not necessarily incredibly pedigreed when it came to the companies they had worked at. But now you look at the executive team that they've brought on board. It's people from Google and Facebook, and so you see kind of these blue chip executives who they're bringing in around them. That's also, for me, by the way, a very kind of great attribute of strong founding teams is the willingness and even the desire to surround themselves with incredibly talented people and people that are smarter than they are even at their particular discipline. And so Tile's been great at that. So yeah, I mean, it's grown up from a company that we started out with just a $200,000 investment to now a company that's gone on to raise seed and Series A and Series B, and I think is already kind of a household name and will become even more of one down the road. That we do a good amount of hardware companies, but most of our companies don't have hardware involved. Another example of a company, some guys that we backed, and then we backed them again a second time. But these guys had built some games on Facebook. They were doing okay, but not incredibly well. And we invested and kind of together pivoted their whole slate of games onto mobile, and particularly the iPad, just as the iPad was coming out. It's called Bash Gaming. They built what became a top 10 game of all time on the iPad called Bingo Bash. And these guys went from having I don't know, $20,000-$30,000 a month in revenue to $2 million a month in revenue in just 6 months. And it's one of the teams that actually sold fairly early. They only raised about $1 million in a seed round, and then they sold for, I can't say the exact number, but 9 figures. Both of the founders did quite well. And now they're doing a virtual reality company that we've backed again. And they're, as I said earlier, kind of going for something even bigger. They invested some of their own money in that, and we're all trying to, in a way you could view it as build the Twitch for virtual reality, the kind of network where everybody will hopefully go and watch people play games, which is not my cup of tea exactly, but there are millions of people who like to do that.
Yeah, when you're talking about those startup companies, I feel like you have a very close relationship with founders, right? So how much time and energy you would commit with each startups like that?
Yeah, I mean, it's a good question. I do become very attached to the teams that we back. And I would say it's a lot of work and effort in the very early days, just because of when we invest, usually there's a lot of work to do. And but while the kind of connection remains very strong, we actually don't do that much work as the company matures, because we were the early investor, and they'll usually bring on great later stage investors who will then join their board. And I will just kind of catch up with the founders at that point when I can contribute, when I can help. But we definitely don't, we're not as in, like Tile, for instance, we're sending emails back and forth to the CEO when we can provide an introduction or have a little word of advice, or he wants something from us. But, you know, and we'll catch up for a coffee once every few months. But in the early days, we were kind of in the trenches together, seeing each other every day. So, you know, the relationship evolves over time.
Mm-hmm. Yes. So it's 10th anniversary of your company. And what do you see the next 10 years of your company's direction, and what's the trend of this industry?
Yeah, I don't see too much change from us in terms of what our mission. Again, I think our mission will remain providing help kind of how and when the founders need it through funding and hands-on involvement. I do think there's a trend, though, that that you know has already forced us to change a little bit where and how we do get involved, and that is there's so much early stage capital in the market, so many accelerators, so many incubators, platforms like AngelList. It really is fairly easy to get a company funded with a small amount of capital, right? Hundreds of thousands of dollars. So that, I think, will trickle down even further, and now you've got these micro VCs that are raising $10 million, $20 million, $30 million. And so maybe even that next round, I think it already has, but it'll probably continue to get easier to raise as well, the $1 million, the $2 million round. You know, since we've moved from investing hundreds of thousands of dollars now to $1 million or a little over $1 million, maybe we'll even move further downstream, kind of as more and more early stage capital comes to play, and even that $1 or $2 million round becomes that much easier to raise. Then again, I believe like one quick kind of correction in the economy could change a bunch of this. You know, we started Tandem in 2007, and when the downturn hit in 2008, I wouldn't say all, but most of the angels kind of packed up and went home for a while. It wasn't as fun as it had been. And, you know, a lot of the funds had to fold, a lot of the smaller funds had to fold. So, you know, the climate changed pretty quickly. Mm-hmm. So, you know, I think we could see if there's an economic correction, we could see a little bit of that. But over the long haul, I think there will be more and more early stage capital available. So we'll just have to kind of adjust and figure out where do we fit best in that ecosystem.
Okay, thank you so much. And right now we're going to open the question and answers So if any of our audience have questions, and our Melanie is going to hand over the microphone to you. Okay, so Melanie, here. Yeah, you can give there. Thank you.
Hi, very good talk. I'm Harrison Rose from Telepresence Robotics Corporation. I'm interested to know how you deal with companies that are looking at a global environment for their markets that are also nationalistic, such as we're working with China and other parts of the world.
Yeah, I mean, I think global markets are very interesting. We actually, for a while, preferred companies that could sell globally, just because it opened up the opportunities that much more and allowed them to adjust as there might be kind of domestic specific issues they had to deal with. I don't have any issue with necessarily selling in China, except that it's been very difficult for foreign companies, non-Chinese companies, to succeed in China, I think. That's just something that I've observed and does concern me in terms of, can a non-Chinese company actually go into China and do well?
That's a big topic to talk about. Yeah.
Exactly.
Yes.
And many of you know more about that than I do, but I just that's a personal concern I have with China in particular. It's not because of the government necessarily.
Have you been to China? How many
Oh
times?
yeah, many times. We
Many
have
times, yeah.
we have actually a good number of our LPs are Chinese, so we have a good number of connections with China, and so we've some of our funding comes from China, but that's very different than investing in companies here that think they're going to go in and tackle China. I'm very cautious about that.
Okay,
Yeah.
Next question. You have a question? Yes. Any other questions? Please raise up your hand. Okay, over there. Can you hand over there?
You mentioned that you are looking for early companies to fund up to $1 million, and they should have a few customers. So for hardware, it takes a little bit of resources to actually build these products and then go out to your customers. So how do you see them bridging that gap of having enough, money to build these things?
Yeah, that's a great question. So a couple of things. I still think there are ways to show demand in hardware before necessarily building the entire product and getting it to market. So on the consumer side, there are these pre-sales campaigns that we all know about now, whether they're through Kickstarter, Indiegogo, or just run independently. A company can show, I think, pretty effectively that there's demand in the market by, like Tile that I talked about earlier. They sold, I think, something like $2.5 million worth of tiles in 30 days through their own kind of independent campaign. And that gave them and some investors the confidence that, wow, when you actually do deliver these things in the market, there's going to be some consumers who want to buy them. And the B2B side of, you can't really use pre-sales, but I think you can get some number of customers to basically sign LOIs or whatever document you need to say, hey, this is a product we want, and if you deliver it to these specs, we will be one of the first customers. And some of our B2B hardware companies have even developed waiting lists with deposits from their enterprise customers, usually refundable deposits, but deposits that show a true willingness to purchase once the product's manufactured and shipped. And then the other point I would make is I think the actual manufacturing of many of these products has become faster and cheaper than it used to be, with ODMs and kind of fast prototyping available and things like that. But even that being said, hardware is still difficult, time-consuming, and expensive. So I think it's a good question, and the more you can prove to yourself that there's market demand and prove to others who hopefully will invest in you, the better off you are, because most founders can't afford to go through the whole hardware development cycle on their own without any indication of market demand.
Okay, we're going to open another 2 questions here. Yes.
Yeah.
Okay.
Hi, my name is Santhosh. These days, I'm seeing a lot of services or products being offered as a freemium model, basically with an aim of getting the customers first, focus on the first 1 or 2 years on the growth, and then look at the revenue models. What is your opinion on that?
Yeah, I mean, I would say two things. Number one, I like the freemium model when it works, and it makes a lot of sense to give the some number of users, a large group of users, a taste of the product, and then kind of entice them to buy more once they hit some barrier, or they want more features or more time or whatever it is. That makes a lot of sense to me. However, I wouldn't necessarily interpret that to mean, hey, let's only give this away for free for 2 years or however long. The freemium model means, at least my understanding of it is, you have a free version, and at some level, you ask the customer to pay you. So I would put that mechanism in very early, experiment with where that line should be drawn, what those conversion rates look like. And again, even if it's not at massive scale, once you figure it out, even with a smaller group, oh, okay, 10% of our free users convert within 60 days to paying, and they'll pay us this much on average, and we can retain them for 18 months. Now you know the unit economics of the business, and if they're positive, if they're very positive, investors will give you more money to go step on the gas and scale that. If you're running what you call a freemium product and you're only giving it away for free, no one knows what those unit economics are, and it's very hard to know whether it should scale. Something like Facebook, which obviously went for a long time without getting any revenue, that's a different story. They never charged their customers directly. Google, the same thing. But yeah, freemium models, I would put in the premium part of freemium sooner rather than later, so you understand what those unit economics look like.
Okay, we'll open the last question for our audience. It's over there. Yes. Okay, please.
Hi, I'm Shreesh from a company called Energy. So I have a question on deep science and hardware. So what is your opinion on capitalization paths for these kind of companies?
So if I can just ask one follow-up. When you say deep science hardware, it sounds expensive to me. Are you saying that basically it's a large R&D and time-consuming R&D project ahead before?
Yes.
I just want to, is that
it's a yes and no, but yeah, I mean, in general, I would say that's the case.
Yeah. So, I mean, number one, I would say what I mentioned earlier, which is if you can find some enterprise customers who think they need that deep science hardware solution, whatever it is, and again, you're at least showing some market demand, and if those customers are impressive and attractive and they seem to be willing to pay you a lot for it, then I think plenty of investors will probably emerge who are interested in that. Of course, they're going to, just like we do with any product, any hardware product, they're going to assess the risk of you actually delivering it. Yeah. So you'll have to address that. But I don't really see it being that different than any enterprise hardware solution. In fact, I would say you've probably got an advantage, because if it's truly deep science and you can show that your team has the ability to kind of crack the code or figure out that formula, then it's probably more differentiated than a simple hardware solution. So investors tend to like that. But if it's like a big R&D project without any kind of evidence of market demand, if that's what, because sometimes science can have a pejorative connotation, then I think it is going to be pretty hard to find private investors to do that, and it maybe is more appropriate to go get grants or foundation grants or government grants or things like that. And there's nothing wrong with that. I mean, there's a lot of grant money out there, and I've seen amazing products emerge from that part of the ecosystem, and sometimes they evolve over and then raise private funding later in their cycle. But if they needed 3 or 4 years to even get to the point where a customer would be interested, it's not a bad way to go.
So just one add on to this. So when you define R&D, is it like a year 2 is defined as R&D or year 2 to ship?
I mean, I'm not defining it one way or the other. Again, I think if you have customers who will commit before you have the product available, you can take a while if they're willing to be patient, and you can still kind of show that the risk is low around non-delivery. But of course, investors would rather see something get to market sooner than later. So there are going to be limits to that. But yeah, I don't have any black and white rules for you or anything like that.
Okay. That's so much for this section, and thank you everybody for being with us, and let's give our hands to Doug.
Okay. Thank you very much. Thanks. Thank you, Diana.
Thank you. Thank you. So we will invite those friends come over and sit to the front. We still have seats here. We will invite David to the stage.